1/4% is what the Fed raises the Fed funds rate to, which was an absolute nothing burger as far as the market was concerned, because that's what everybody thought they would do. I had said many times I thought the Fed would raise another quarter and interest rates would fall because of that. And if you look right here, rates actually fell down to 6.38%. And if you look at this chart right here, it shows you just how volatile rates have been. Which just like in October, November of last year, we were all the way over 7%. We went all the way down to 6, all the way back up to over 7, just barely. And now we're back down under the mid 6s. And again, people are doing buy downs and paying points and getting really down close to 6% again, which means rates are falling. Even though the Fed in the meeting said that they are now data dependent, they really kind of left it out there that their target is probably to raise the Fed funds rate another quarter, but that's already priced in. So at this point, unless the Fed really does an about face on their targets for inflation, then probably, most likely, I don't have a crystal ball, that rates will continue to fall, which I've been saying I think rates will fall faster than most people think, but I think that's a trend that you're going to see throughout the year. But there is something else that we do need to worry about. If you look right here on this article from Fortune magazine about the U.S. housing market is holding up the best in the global correction. What the interesting part of this article was not even about that. So to me, it said that right here, U.S. home, I'm going to scroll up here, U.S. home price correction, which is a 5% correction, is the second biggest U.S. home price correction of the post-World War II era, which shows you just how good of real estate is for a long-term investment when a 5% drop is the second biggest drop since the World War II post-era. But this is the thing that I think we need to be paying attention to here for the most part. There's one wild card, economists say, that distress in the global banking sector could lead to tighter standards and cancel out the tailwinds created by future declines in mortgage rates. And that's a mouthful right there. Because with the craziness in the banking, is there going to be a run on banks where you're going to see all these banks closing? The answer, and I'm going to say as close to 100% no as it can be, because the government is heavily involved in protecting the banking sector. What that does mean is that when you see this going on, banks are getting, they're getting tested more as far as their liquidity and the stress tests and things that they have to go through. They're getting tighter on their guidelines. And what this article is saying and what that statement there is saying is that if banks tighten up their guidelines, even when rates fall, that actually can counter against that because it means less people will be able to get loans because the guidelines will be tightened up. And we have already seen this. If you look right here, Fannie Mae released their new release 11.1. The new DU desktop underwriter, which is what we use to make sure clients are pre-approved up front. And basically they updated this on February 25th, an updated risk assessment that will fine-tune DU's ability to assess risk while fostering homeownership sustainability. And if you look right here, they're going to do another update to 11.1 on April 15th. And I'm seeing more and more of these updates come in. Now, it's not that uncommon for them to update them, but they have been updating them and getting a little stricter on things like cash out refinances, investment properties, multi-unit properties. And I think that's where you're going to see the guidelines continue to tighten up. At the same time, which is kind of good, I guess, for being in the industry, is they're getting a little more lenient on first-time home buyers as far as giving them a little better rates, a little better adjustments, some of the new programs that are coming out, and in some cases actually allowing for little higher ratios. But in all, that could be a little bit of a net negative, meaning first-time home buyers getting a little bit back in, but then investors and second homes and some of these other things, guidelines getting a little tighter. So we'll just have to see. Nobody knows for sure what's going to happen, but there's 3 things that I think that you should count on. There's so much noise with, inflation and is there going to be a recession and unemployment. Most of that's just noise. If you kind of just tune all that out and think about a few key things, I think it makes it very, very easy to see what, us as mortgage people, real estate agents, investors, anyone in this market, what we should be doing for sure going forward in 2023. And that's count on these 3 things. 1, rates will be lower. I think rates will be maybe below 6%. Heck, we could be at 6% in the next month or so. So rates are going to be lower, I think lower than what people think, which is going to create more sales. More people will buy when rates fall. But 2, there's, in my opinion, that you can count on. There's not a meaningful amount of inventory that's going to be coming on the way. Builders don't have a lot of houses all of a sudden they can pop on the market. Also, rates going to 5.5%, which would be a big drop from where we're at now, is not going to get a lot of move-up buyers back on the market. There probably is not going to be a meaningful amount of inventory to come on the market, which means that prices are going to be fairly stable. At the same time, it's going to make it harder and harder for buyers to buy as rates fall. And then the third thing that I wrote down is there's going to be less people in the business. Just count on it. This is exactly how it's going to be. It's going to feel a little bit like this. I think there's going to be months where sales go up, and I think sales are on their way up. But I think it's going to be a market where you're just going to have this constant dance of limited inventory and affordability being a little bit better with rates falling. But at the same time, there's still being a lot of competition to buy these houses. So that's some of the things to be thinking about when you're creating your strategy of what you should be doing. I hear all these people saying, oh, there's a market shift. There's a market shift. Yeah, there is a market shift, but how you approach that market shift matters. I think having really good partnerships, counting more on your own systems, how are you reaching out to your past clients and leads and all those kinds of things. And in this environment, I can tell you 100% from doing this for the last 20 years, having a lender that knows all, not just the programs, but how to take those programs and apply them to different clients, whether we're helping them with their credit or doing these creative things, is going to make a huge difference on your income in 2023. So we would love the opportunity, if we're not already working with you, to show you what we are doing that's different. If you want to get together for a brainstorming session, we have a class every Tuesday. That's the biggest online gathering of realtors anywhere in the United States. I'd recommend going on to our class on Tuesdays. And if you need anything, reach out to me, my team. I'd love to help. Have a great week. I'll talk to you soon.